What's the flavor I need to focus on
For
your
cigars?
cigars and broth?
Well, I brought mostly mild stuff, just to appeal to a wider audience. So you're gonna be getting notes of toasted cedar. You're gonna be getting some, maybe some dried fruit,
Nice.
things of that nature.
These are the cigars you bought?
Yeah.
Rob, are you guys in the Capital Collectors?
Yeah.
Are you doing Puerto Rico?
No. No, I think it was a couple years ago we went to the Cabo one.
Yeah.
But we haven't been to one ever since. Not that it's bad, it's just can't be at everything.
Right.
Yeah. All right, well, we still have plenty of time, so no big deal.
We are going to do lunch at
11:45?
Yeah.
Yeah, so we'll do 30 minutes here. All right, so as you guys are getting settled, I'll just go ahead and get started. So the purpose of this conversation is to talk about underwriting, but it's not necessarily the nuts and bolts of, oh, well, payroll is this and repairs maintenance is that. That's obviously very important, but we're talking about it more high level, specifically from the lens of a fund manager. Because as a fund manager, there's an extra layer of underwriting that you need to go through, because you're not just investing or making an investment decision on behalf of your investors, right? Which obviously that's number one. Number one is figuring out, is this a good deal that is in alignment with what I want to share with my investors? But also there's a secondary concern, which is, as a fund manager, am I being fairly compensated for this partnership, for raising this money, right? And so this is where our industry has come a long way, because a few years ago or so, everything was co-GP. And with co-GP, things were perhaps more straightforward. I mean, I certainly like it, but things are also less clear on the surface, right? Because you just say, oh, well, I'm going to raise $1 million and I'm going to get a 35% proration of the GP, or I'm going to negotiate and get a 40% proration, or whatever the case might be. But the way that our industry has trended with fund of funds, things have become more systematized, things have become more sophisticated, where people are savvy enough to now figure out, okay, well, actually, I don't really care about what the allocation I'm getting and so on is. I care about what is my projected compensation as a percentage of what I'm raising, right? And that really cuts to the heart of it, and it really makes everything apples to apples. And you can do this calculation for a co-GP partnership, for a fund structure. So it really normalizes things across the board, where you can really get down to the nitty gritty. And so in our business of multifamily, and I'll explain in more detail why this is, but in our business, it's industry standard or kind of market to see projected compensation for a fund manager on a 5-year hold of about 10 to 14%. And so there's a low end, there's also a high end, and then there's also numbers that go maybe outside of that range. And why is there a range, and why can numbers vary? It's for a few reasons. And this is where I think it's like, now is your time to put on your savvy fund manager hat on and kind of think through the different angles of the deal. Because first and foremost, quite simply, in our alternative space of investing and raising money, existing multifamily acquisitions is the easiest strategy to raise money for. Maybe you could make the case debt funds are easier to raise money for than multifamily investments because of the liquidity. But we can all agree that raising money for a Bitcoin mining fund is a lot harder than multifamily. And even development. Multifamily development is harder to raise money for than multifamily acquisitions. And so you, as a fund manager, should be compensated more or less based on the difficulty of the raise. And that's just one feature. That's difficulty. The other feature would be, of course, risk, because as we've all learned in what has been the last 3 years of a down market, basically, uh, it's easy to get carried away in thinking about what's the return, what's the investor's return, what's my return. But it's also really important not to forget and also to stress what is the likelihood that I get a return of my capital. And that is something that when you're just looking at numbers on a spreadsheet, there's not going to be any flashing warning signs of that, right? It's hard. You have to look beneath the surface at the risk and say, okay, what is the risk of the deal? Are my investors being compensated fairly for the risk of the deal? And also, how hard is it going to be for me to raise this money? Am I being fairly compensated for the difficulty of the raise, right? Just straight up, very simply, you should not make the same fund manager compensation raising money for a down the fairway Dallas multifamily deal as a ground up development in Mobile, Alabama, or wherever that is not Dallas, right? The best market in the country. Sorry, Austin. So, yeah, that's the first premise. Does anybody have any thoughts? And again, I said this to the last group. This goes without saying. I mean, all of you guys are very experienced, sophisticated, doing your own stuff. I mean, Aspen is doing stuff that is not multifamily, so you guys have a perspective on compensation and difficulty of raising. All we raise money for is multi. So if anyone wants to contribute or provide a perspective, please.
I think all your points will make a lot of good sense. I get stuck on the old metrics or the traditional metrics. And I think the concept of looking at your comp versus your raise and adding difficulty, that makes good sense. Just resonating.
Okay.
With what you're laying down.
And so when you say you look at old school metrics, what are those?
Well, I think to your earlier point about participation in the deal, right, in terms of equity share and such, is kind of where I go typically. But that's not always available.
Yeah.
What do you revert to? Right. And what's the payout ultimately? Well, to hear a little more about. So I know like certain asset classes a little more difficult. There's more headwinds in capital raising in this current market condition. Are there particular asset classes that you would sort of deem like less difficult? Therefore, maybe you're going to consider going back to your points about level of difficulty and compensation. That you'd say, what, for this type of asset class situation, I would probably consider taking less because I think I'm going to get there faster.
Right.
Right. I mean, my time's also valuable. I'm going to move on to the next slide.
Exactly.
I just appreciate just like your survey.
Yeah.
The market from that perspective.
That's a great point. I think generally speaking, the underlying risk of the deal should trend roughly with how hard it is to raise for, but not always. Because risk can be perhaps distorted or unseen, manipulated, and it's really all of our jobs in this room to make sure that we're being good stewards of capital for the people that are trusting us and that they don't have the time or the sophistication or just the domain expertise to actually see those risks. You got to see those risks for them. So that is, that's kind of that's why we spend so much time like looking at a million deals and thinking about all the risks and, weather risk or flood issues or, something as simple as leverage. Leverage can be lost on people to an extent because, what's the big deal? 75% leverage, or 75 versus 80, 75 versus 80 doesn't seem like a big deal, but in reality, that's the difference between being 4 times levered and 5 times levered. And that's a huge deal, right? And if you're at 50% leverage, that's 2x. And so there's a lot more downside protection the lower you go. And it's very simple, everyone knows that, but it's forgotten because on the spreadsheet, the more leverage you use, the more you make for everyone, for the investor, for you as the fund manager. So something has to give. As a fund manager, you can't serve all these masters, right? You can't have both low leverage, invest in a super high quality deal in the best sponsor in the world, and then also get the best compensation in the world, and the returns to your investors are sky high, right? Like some of those things have to give. So to answer your question more directly, which I think is like more applicable to today in the last couple of years now, is there's been a big bifurcation in the market as far as what is liquid and investor appetite. When it comes to institutional investors, 80s deals are, to a good extent a no-go, and it's kind of 90s and newer, and a lot of institutions are trading out of their 90s product right now into 2000s, which is great because we'd love to buy their 90s product. There's not a ton of it out there, but for them it makes sense to sell it at not the top price right now because they can also go and buy the 2000s deal at not the top price. The problem in the market really is in the 70s and 80s deals, and in particular the 70s deals. And it's not for a totally wrong reason, but try raising money for a 1970s deal today. It's very, very difficult. We did it last year. It was really, really tough. It's just I don't need to put myself through that brain damage, and if I'm going to put a fund manager through that brain damage alongside with me, they should make more money. They should, right? It's just fair. It just makes sense. But at the same time, if I do a 2005 deal in an amazing location, super low risk, it's not a value add, I'm buying good in-place cash flow, the fund manager should also see that and recognize that and say, you know what, this is a good deal, I'm going to be able to raise it, I have a greater certainty of the outcome, and therefore my compensation should be on the lower end of the range rather than the higher.
So when you're buying this 19 vintage from the institutional sellers, has it been managed in a way where you got upside on value add or better operational management?
So, every owner is different. I don't want to paint all, big owners, small owners with the same brush, but what you're seeing is, generally speaking, right, the big boys know how to manage their assets. They're stable. They're not going to have skeletons in the closet for the most part, but maybe they run some of their expenses fat. Maybe they push down some of their truly corporate overhead to the property's financials. So, maybe there's some expense savings, but that's really case by case. What I think is my personal view is that a lot of these deals are great value adds, just not right now. Because right now there's supply. Why value add your 90s deal when your rents are going to be in line with the concession rents for the brand new deal that has better amenities, and it's just, you'll never be as nice as that deal. But assuming what happens in the market as far as slowdown in supply shortage, we're going to see a rebound. We're going to see, people are buying on the premise of very strong rent growth. And if that happens, that's the environment to be doing the value add. So you might buy the deal, it's not a value add today, but it's a value add later, which is really an awesome place to be because you have the flexibility to then do, you could start doing a value add later, and then you could sell the partial value add, sell the dream to the next guy. Or you could do it all yourself, perhaps out of cash flow, or if you're really creative, maybe make a capital call if you didn't raise the money up front for that value add, but it becomes apparent later that you want to. That's, capital calls are just adding complexity to the deal. I would never want to, do that or pitch it up front and say, hey, we'll do a capital call later to do the, I wouldn't want to do any of that. But we're actually looking at
as is with positive leverage where you can just sit there and hold it.
Yeah, I think that's the best play. I think time and time again, and Sam in the back is, seeing these deals right there with me. Time and time again, when we're looking at deals right now, they might have a partial value add already, meaning the seller is trying to do this, they're just too early, right? And what you look at is, sure, the OM is flashy. OM says, oh, look at the before and after the kitchens, and they're getting these rent increases. But when you dig in, the rent increases aren't there. The rent increases are actually much lower than kind of what they advertise. They might only be getting $40 premiums on a major renovation. That's not worth it. And then also when you look at what's the occupancy rate of the classic units and what's the occupancy rate of the renovated units, they're not equal. The renovated units are sitting there vacant, and the older, cheaper units are full. So why would you buy that deal and say, yeah, the seller knows the deal better than me, but I'm going to buy it, I'm going to renovate it, and I'm going to lease it up and get all the units at the higher rent. So you're seeing it just play out right now as too early.
Have you guys raised at one of those like delayed value add type of, like put everything up front and raise for a delayed value add 5 years or 3 years on the road? Or
No, I was actually that's what I was going to bring up. We're looking at a deal right now where, well, we're still, it's early stages on the deal, but it's this exact story where it will be a great value add. It's just not right now. And instead of raising the money, I would just want to effectively escrow a portion of the cash flow for the value add later. And basically, in practice, what that looks like is when a tenant moves out and you are turning over the unit, the worst shape that unit is in, if it's got broken appliances and stuff, that's the unit that you gut, renovate, and now we're going to go and try to get that premium. And then there's no rush on these things, right? Because we're not there yet. It's not like the market's going like this. So if you do the value add, if you do 20% of the units over 3 years, that's not that much money spread out over 3 years. And then when you sell in 3 years, you're going to have a partial value add and the market's going to be going crazy and you'll get a big number. So yeah, I have not done that. We have not done that. And I would say it's more practical to do like 15 to 25% of the units out of cash flow.
In this scenario, are you not paying distributions to investors for that kind of first few years of the deal and just putting it back into escrow for future renovation, or do you kind of partial?
No, you'd be able to cash flow still. Yeah, because my math is basically you'd be able to do the value add that over 3 years, you'd be able to do 20% of the units over 3 years with only about 1,000 per unit per year. Yeah, that's how it breaks down. So 1,000 per unit per year doesn't eat up all your cash flow.
I also challenge people to expand their mind a little bit on value add. I mean, a week ago, we made a change on a deal that we acquired last year, and it was literally just a week ago we made the change. And we had a certain amount of units at a particular location that weren't leasing. They were smaller units. They're studio units, right?
Classic?
Classic. Everything's classic. But they weren't moving. And so a change was suggested that we run it as an all bills paid model because of how small they were. And in 1 week, I talked to the asset manager yesterday, units started moving like crazy. Applications were coming in because we moved the model to an all bills paid model. We didn't touch anything in the unit, but we did something a little slightly different the way that we presented the unit, and it was considered to have extreme value to that local market. And so those units then started moving. And it was a unit type that we were not stabilized in for that property. But all we did was change the way we marketed the unit.
It was a marketing play, yeah.
And it was considered a true value add for that unit.
Was it a premium? Did you get a premium margin on that,
necessarily say
or
we
was
got
it
a
just a
premium.
cash flow?
No, you break even.
I wouldn't say it's a premium at all. You break even on the utilities and the things
Okay.
that we offer, but we now are moving units because it's offering something that is value to the clientele, to the residents that want that from it.
Yeah, similarly, we had a deal that had same exact situation. We had these small studios, and there was 22 of them, I believe, at this property, and they were all vacant. Nobody wanted these studios. And so we took one of them, furnished it, made it a model, and showed people what the studio could look like. And then you tour them through that model, and then now the studios are all full because they see what the finished product looks like, they get it, they lease it, and now it's there. So yeah, studios are tough, but it was Sam's idea to do all bills paid because basically you're attracting perhaps a student demographic. They don't want to transfer utilities in their name. They just want, hey, I just want one number, I want to move in, and it's just a studio. And
most people can't see the finished product on some. It's even in residential real estate, you have to stage houses, stuff like that. The results are incredible. Like you walk into an old junker property, or dated stuff, it's just not going to move as quickly. So it's fascinating to hear that perspective.
Sam, just make sure I understand. Let's say you had it for $800 today before you
change. And you thought the utilities were $50 a month. Did you go to $850 or leave it at 800 and say I'll pay?
I think we're slightly below where that is, but that's something we can move.
I think we decided. Yeah. Sorry to interrupt you.
Yeah, we need to move the units. I mean,
Right.
there's so many of them.
So you just
If we
said-
get to a point where we're stabilized, we'll start bumping that number.
Perfect.
I mean, clearly it is.
Better to get
Cash in the door.
better to get them out. But
Yeah,
For sure. I mean, I'd rather
Awesome.
make $700 a month than zero.
absolutely.
You know, and so would our investors. And so part of the benefit of a value add strategy, right, is people really need to challenge the fact that you don't have to necessarily go out there and spend a whole lot of money to create value. One of the benefits of investing with somebody like Lone Star is that we're being fully vertically integrated. Robin and I were talking about it yesterday. We were just walking the river here, and I said, the benefit of being such a small, nimble company like this is we can be discussing things, and it becomes policy right then and there. That became policy. We can change that, right? And so that's part of the benefit of having that full vertical integration too. That takes some of the risk off of fund managers when you're looking at all these things and evaluating it from an underwriting perspective and compensation perspective. There's additional value out there. You just have to understand where all those values are, what that does for the risk associated in the deals.
So, speaking of risk, I want to bring it back to fund manager, risk, evaluation. And we talked about how if the deal's harder to raise for, you need to compensate yourself for your time. If the deal's riskier, you need to make sure that your investors are compensated because they're the ones putting their money in. And you need to be compensated because whether you're putting in $1 or not into the deal, you're putting in a lot of relational equity into the deal, right? And that's actually the most important. So it's actually in reality very difficult to be appropriately compensated for the risk of the deal because of just how impactful a downside scenario is to all of our businesses. It's like, well, we don't, maybe some of you, I know you have a fund and stuff, different funds, but we don't operate a fund. So we don't get to have winners and losers, because you might have an investor invest in one deal and then they're just going to see how that one deal goes. And so we want to have a series of every deal being at least singles and doubles rather than a fund. Well, we invest in 10 deals and if one goes bust, it's okay, we've got the good 9. It doesn't work like that in our business. And for many of you, it doesn't work like that either. So it's really, when you look at it from that perspective, it's really hard to actually look at the risk honestly and say, I'm actually being well compensated for this. You're probably not. Even if you are projected to make 15%, 20% on what you raise, it's still probably not worth it. So in line with this, like I said, the market has gotten more savvy, more sophisticated to where people are saying, okay, well, what's in it for me? Not saying that's the wrong thing, but what's in it for me concretely as far as how much am I projected to make as a percentage of what I raise. And also, I think most of you guys already understand this in the room, but that compensation percentage is comprised of 2 things. It's the upfront fee, generally speaking, which you charge to your fund, and that is, we see as pretty much standard across the board, 2%. So that means the other 10 to 12% plus has to come from the promote. Promote's 5 years away, it's subjective, it's risky, you don't know what's going to happen with that promote. And the thing about that promote is it's very volatile. Even just a slight change in your projected sale price will change the promote and your share of it dramatically because when you sell a deal, you've got first paying back the lender, then paying back the investors, then the profit split with the investors, then your promote. So every dollar of the sale price really is a big change on what the promote is at the end of the day. So this brings me to an important point. I feel like there's some really healthy things about going through what the market has gone through over the last few years. I feel like people are coming back to the ground and people are being more conservative and us included. We're learning tons of lessons and it's really great. However, I still see that there's some distortions in the market. There's still some excesses. And one of those things is, basically sponsors, for various reasons, I'll explain those, are offering 90-10 split. Nothing wrong with that. I'll explain that. If you catch us on a good day, maybe with the $5 million, maybe we'd give you a 90-10 split. But we're also seeing in that vein 100-0. right? So that's not even a profit split. That's just a, hey, you have everything and I'll take nothing. It's like, hey, this is a great deal, but I don't need any of the upside. You keep it all. So to me, this is just a perfect explanation of, or example of what's wrong in the market and how things are more complicated than they seem, right? Because this, just to use the most dramatic example, this 100-0 example. So first of all, the biggest red flag that jumps out to me with the 100-0 is what I just explained. Basically, you're banking on the sponsor to deliver a long-term positive outcome, but they're willingly giving up all the benefits associated with that long-term positive outcome.
They're just taking
Just all fees. So,
Cash flow.
Well,
Do
they're getting
they
paid
capture
upfront.
cash flow?
well,
Everything's
if
upfront.
I mean, if they put in capital, their capital investment would get cash flow, but assuming just their, promote compensation and their fee compensation, right? They're going to make an upfront fee, an asset management fee, whatever fees they have. Point is if it's 100-0, they're not making any promote on the top.
And they're also negatively incentivized with respect to you because they're incentivized to hold that deal as long as possible. Because
Because of the collection of the fees.
Yeah,
There's
I think-
There's nothing good about the sale for them.
yeah, no, I think it's really important to think about that as a fund
It becomes an alignment issue.
Not
Yes.
motivated.
Exactly. Exactly.
Yeah. I think alignment is from a sale. I used to do sales comp, and the company would say, "Oh, why aren't you guys selling this? It's a better product. Well, you pay the team less." They're like, "Yeah, but it's better. You guys should want to sell it." I'm like, "You're not incentivized."
Adjust the comp.
Yeah, it's like, well, so I think, whenever anybody's going and working with somebody, you have to be very conscious of that. That would be a huge red flag. I'd say, no, there's no way.
Right.
They're likely gonna have to fatten up other fees to adjust their comp that's not incentivizing the upside that you need to go hit.
Who's doing that?
This is not charity, right? Who's doing that? I mean, I don't want to name names.
You can ask around in this group. And
Okay, good.
I saw a Facebook ad the other day that was promoting, I don't even remember the group, because I never heard of them, but 100-0, I'm like, that's insane.
So it's so easy to see the distortions, if you will, or the insanity when it's 100-0, right? Like now it's all clear. Now it's like, okay, incentives aren't aligned. They don't need to sell. You said they're going to have to make it up on fees. So, and there's some other things, right? It's also, what does this say about their belief of the deal, right? So with 100-0, all these issues become clear as day, but
They're the same issues. with
they're the same issues potentially with 90-10, right? Exactly. Potentially. I mean, 90-10 could be structured in a way. Yeah, exactly. So the 100-0 really points it out, but the 90-10 is still inching towards that reality. And so you as the fund manager have to analyze, well, what is the totality of the deal? Because it's all in plain sight. What's the fee load? How much is the sponsor making this much on fees and then this is their projected promote? Or is it maybe more balanced? And so if you start looking at deals through this lens, you'll actually have a frame of reference because right now, probably most of us don't have a frame of reference of what actually is a fair split for the sponsor to be making on fees relative to the promote. And that is an alignment of interest thing. In reality, you want the sponsor to be projecting or to be getting the biggest share of promote as possible, while still, of course, you being fairly compensated and your investors being fairly compensated. So really, it's a three-way dynamic: sponsor comp, sponsor comp, fund manager comp, fund to fund investor. Right? Everything has to sync up nicely together, which is kind of why when we underwrite a deal, we don't just stop there. We underwrite it through the through the deal level to the fund manager comp, fund to fund investor comp, and we kind of look through the whole thing and make sure that everything ties, and we try to get parity between direct investor, indirect investor as best as we can. So yeah, that's the 100-0 just makes kind of these sponsor DD deal structure things really clear when you look at it that way.
Is it fair to say that you've stopped conversations with a deal because of an imbalance, with the retail investor, with the fund manager, with yourself? Because while you might be getting the deal at a discount, given projections and exit cap, that it didn't satisfy those three pillars.
Yeah, absolutely. There's a lot to say on that. Actually, one point I forgot to mention about the 100-0 is there's two reasons why. I mean, we didn't really address why. Like, why would somebody do the 100-0? And I pointed out, it's not for charity, right? We can't assume that's people being charitable. The first thing that we can assume is desperation. And desperation sounds bad, but actually desperation could not be a bad thing. It could be they're an emerging sponsor, and so they're just new. They don't have the relationships, they don't have the trust, and it's okay to be desperate. Certainly I wasn't commanding terms on my first deal, right? I was taking what I could get, and I was making concessions because it was it made sense, right? So the first point is desperation. So you could be desperate because you're new. You could also be desperate because you're in a bind. It's a particular deal that you close and you have bridge equity that you need to buy out or something, and so there's just deal specific things that you just you need the equity and you're just willing to be done with the deal and move on, or you're just generally struggling to raise the money. It could be an experienced sponsor, could just be a tough time to raise, tough deal to raise on, and so that's where the desperation could come in. The second reason why someone could be offering 100-0 is just very simply they're making enough on fees to where they're happy, right? And so this is a true distortion in the market where people have become hyper fixated on what's my split, 80-20, 90-10, 100-0. So a sponsor can then concoct a deal structure where they can appease people and say, sure, here's the 100-0, but just I'm actually, I'm making my share here on fees, which is actually the worst of all worlds because the sponsor is getting guaranteed money and you're the one taking all the potential money. And that is a terrible situation to be in.
I think one of the data points to kind of look at that analysis is sponsor co-invest.
Yeah.
I actually saw a deal today, it was a 90-10, but the sponsor was putting 30% of the capital in. So that scenario actually, it brings confidence, right? Because they're riding on the same, structure as they'll probably everybody else. But if it's 90-10 or 100-0, they're putting in, the minimum, take a huge 5% fee up front.
Right.
Running.
Yeah, co-invest is a big risk mitigant. We talked about that in the other group, talking about ways that a deal could be riskier, deals that way it could be less risky. And to your point, when I was talking about risk, I was talking about it through the perspective of comp, fund manager comp, right? The riskier the deal, the more you should be compensated. If a sponsor is saying I'm putting in 30% of the equity, you should feel really good about that deal. Maybe you're not going to get the best comp on that deal. And probably justifiably so, they have that perspective. Tim, go ahead.
Yeah, well, I'm looking at a deal right now from a very experienced sponsor that is offering 100% at the highest tier. And I asked about that, and he said, well, yes, we were offering that. However, out of the 25 million that we have raised so far, only about 5 million that fits that criteria. So we're still making money on the other, on the others.
Yeah, so that sounds just like, and again, desperate sounds bad, but this is business, right? Like if you need the money, you need the money. So that sounds like a, experienced sponsor, and they're just desperate for, they're desperate for the gap.
Last 5 million?
Well,
No. So the total raise is 30 million.
Yeah.
So they've raised 25 million so far. They still need to raise another 5 million. However, out of the 25 million they've raised so far, around 5 million of which gets 100%.
Because they're only offering the 100-0, the best split, if you raise above a certain amount, right? They're not going to give that to the 500K partner, but for the $2 million, $5 million partner, they'll give that. So so it's to be most precise, they're quote unquote desperate, not just for any money, but for big chunks, right? Which makes sense. There is value there, right? Less burden on your investor relations team and speed, and building a relationship too.
I would say though, the sponsors still got to make money, so they're going to make it somehow. If they're even offering a portion of their investors a no-fee option, that might be disproportionately impacting the other share classes that are paying a bigger share of it, right? So you got to look at it all in hand, because yes, they might be saying we're taking money over here, but I don't know, it's something about that just, it doesn't feel right.
Yeah, I agree.
And you got that look on your face. Tim and I have already talked about it. That's why you know who it is.
Yeah, awesome. Okay, cool. So we've got maybe just a couple more minutes. I think I covered all the points I want to talk about. Yeah, the risk stuff, the 100-0, co-invest. Co-invest is a good point that came up in the last one as well.
Our fund manager toolkit. If nobody here, if you don't all have that here, I highly recommend that everybody download it.
Pull it up.
It's something that's it's
Who was it?
significant
Your underwriting tool.
It's
Yeah.
the underwriting, it literally is the underwriting toolkit. It shows
Is that what it is?
how to get
Yes.
compensated based upon the deal.
It's just we added some more features,
an
but it's the same
ideal
thing.
for everybody to have because it literally shows you you can actually stress test things, you can change things, you can actually see how it would be if it were, all right, I can't get 90-10, can I get 85-15? How does that look on my numbers? How does that look for my investors? You can do all those kinds of things with this toolkit. It's an ideal thing for every fund manager to have, I think.
Yeah, very much so. And you can not just scenario test, like you're saying, with, okay, 85-15 or 90-10 and so on, but you can also stress test the returns. And if, just playing with that one famous button of exit cap rate, you can see, okay, well, if we're actually selling the deal for everything else is held constant, but we're just selling the deal for less money than we thought, you can see what happens to your projected compensation, right? And it can go from a big number to a small number very quickly, or it could go from a small number to a big number also very quickly. And so that is the key. And like I said, the market has gotten a lot more savvy. People are experienced, people are doing this professionally, and this tool and just this methodology allows you to compare apples to apples. Whether it's a co-GP model, whether it's a fund-to-fund deal, you can normalize things, look at things, and really keep things all together. Did you make this just now?
No, I had this from a previous presentation.
No? Oh, yeah.
Is it working, anyone?
It should. Yeah.
Amazing. One thing, real quick, we have lunch, and anyone who's in group B that's here, please come back here after lunch. You're gonna be with Craig and Sam. So group B people.
Okay. I don't
Cool.
think anybody here is group B.
I think just
Well,
Chris.
This is group B. Oh, you guys get to stay here.
This is the best. This is the best room.
B stands for best.
Yeah, B stands for best. Yes. Okay.
Speaking of that, because exit cap is something I don't think we stress enough, in particular as fund managers, it will have the greatest impact on your compensation.
Right.
That one metric will have the greatest impact on your compensation. So stress testing it to where the market is today, where you think the market may be in the time of sale, based upon the business plan of the asset, is important to know because it drastically changes what you're compensated on.
What metric was that you were?
Yeah, exit rate cap, and it's in this model.
Yeah, and it's exit cap rate. I feel like there's been so much attention paid on the exit cap rate over the years that it's almost like a villain. But in reality, it's just a projection that you have to make, and it's also a projection that is not, again, it's not villainous to make that projection, because if you're buying real estate, you're buying it probably because you think real estate is going to do well over the next 5-10 years or whatever, right? Like, we wouldn't be sitting here, we wouldn't be investing in real estate if we didn't think this was a good strategy. So it's not villainous to have an optimistic assumption about the future and say, you know what, I think we'll be able to sell this deal in 5 years for this price, and let's hope, right? It's good to have hope. It's good to be optimistic. What's not good is to obviously be unrealistic, but also to be banking on that and not having a contingency or to have the deal work out if it doesn't work out, right? That's really, like, I'm just me personally, I'm okay. I don't get freaked out by a high exit cap or like a low exit cap rate, which means high future exit price. You know, I just need to make sure that if we are not selling the deal for that price, we can still hold it and still have good cash flow. Everything comes down to, good fundamentals, good cash flow, and having a low risk deal to where we can, refi and hold longer if we need to, live to fight another day, and if we do end up selling for not our absolute top price, it's still a good deal. And there's really no better way to make sure all those things I just said are true than by having a good amount of debt on the property. Not too much, it's hard to be too little, but yeah, just having, like I said before, the difference between 75 and 80% leverage is a world. It's a big difference. It's 4x levered versus 5x levered, and a lot of deals we're looking at and have closed on, it's 65% leverage. We even did some deals at 50% leverage in the last couple years. So when you do deals at that low of leverage, it really opens up it tightens up your expected outcomes. Like, for example, we're bidding on a deal right now in Houston, awesome deal, and the seller bought the property they're all in for $105 million. And our bid is potentially the top bid. It's at $82 million. So they're losing 20% on the price. Now, if they were leveraged 80%, that'd be 100% loss of equity. But fortunately for them, they're only leveraged to $65 million. So they're actually not going to lose all their money. They're going to lose half of it, let's say, right? And that's that's a 50% drawdown when you have a 1 in 100 year interest rate move in 2022. It's really not that bad. So it just shows you the power of real estate when it's properly leveraged. That's kind of a topic that I'm working on. I don't know how I want to present this, but I'm trying to figure out a way to come up with some content talking about how real estate is actually riskier than you think, and it's like actually riskier than stocks unless you lever it properly, the way that real estate should be levered. And so I don't know, it's a working topic that I'm trying to figure out. I have a
To clarify, when you say a good amount of debt, you mean as low a debt as possible?
I would say no, because real estate is meant to be levered. It absolutely is an asset that is meant to be leveraged. And so I would say it very much so depends on the deal. But if we're just speaking generally, I would say the sweet spot is 60 to 70. Yeah, 60 to 70 is the sweet spot. And of course, it could be the higher end, the lower end, depending on the type of deal you're buying, the stability of it, and the cap rate. The more positive leverage you have, the more you can afford to lever, and it'll be coming out to the same debt service coverage ratio. So it's you could be levering a deal at 60%, and that could be high. It just depends on the margin that you're working with.
Did I read that Fannie Mae has softer debt service coverage ratio in recent months? That there's a tweak to their
No, I don't think so.
underwriting? Okay.
They're always making fine tweaks, fine tuning. For example, they can size the deal based on a 35-year amortization, which is a lower payment, which then means that the deal can justify having a higher loan amount. So you could go 35-year amortization. You could, sometimes they're willing to go to a lower debt service coverage ratio, but that's more rare. 125 kind of is the gold standard. So yeah, it's there for a reason.
And if you opt for lower debt service coverage ratio, then you're in essence putting the investors at risk also.
Yeah.
You know what I mean? So.
For sure. And here's the thing about DSCR that I don't think really anybody thinks about, talks about. So 125 simply just means you have $125 of income for every $100 of debt. That's great. However, you have asset management fees. You have CapEx every year, because just because you say repairs and maintenance is $600 per unit per year doesn't mean that's all you're spending every year. Whether you like it or not, you're going to be spending in our world, more like 1,800, 1,400, 1,500, 1,600, 1,800, 2,000 per unit. So whether you put that into your operating expenses or it's below the line, it's an expense every year. It's going to have to come from somewhere. A lot of people raise the money up front to be able to then pay that CapEx every year. But if you run out of that piggy bank, because you have to hold for longer than intended, it's going to have to come out of your cash flow. So really a 1.25 DSCR is not as thick of a margin as you think when you look at asset management fees. You got to pay your accountant for the K1s. You've got your CapEx fees. There might be a lawsuit on the property. There's stuff. There's just stuff that happens. And so I'll just share, two quick things, or one quick thing that is helpful for this. One thing is our so a 125 debt service coverage ratio is on an amortizing payment. You're paying principal and interest. The key to real estate is to never pay your principal, right? You want to be interest only, so you maximize cash flow for investors. So if you do an interest-only loan, that means you'll never be amortizing on this loan, which is going to help you with the realities of the cash flow, right? So that gives you a boost. Interest only gives you a nice boost, gives you more cushion. And so when you opt for a full-term interest-only loan with Fannie Mae or Freddie Mac, it's going to be at lower leverage, because if you're never going to amortize, they're going to say, okay, well, fine. If you're not going to amortize, then we're going to start you out with a lower loan amount right off the bat. So you go lower leverage, full-term IO. The other beautiful thing is when you go full-term IO, they'll give you a lower interest rate. So now you're helping your DSCR as well with the lower rate. So you've got kind of a trifecta: interest-only payments, lower leverage, lower interest rate. And then from there, what we do is we calculate the real number. We calculate not just what the NOI is, which is highly manipulated. We look at what's our all out the door expenses for our accountant, for the K1s, for our legal fees, for having all these Delaware entities and Texas, franchise taxes and all this stuff. And then of course the CapEx, which you have every year, because you're going to have 10% of your HVACs going out every year. You're going to have to replace flooring. You're going to have to replace stainless steel appliances. So we calculate all those expenses at the end of the day, and then we look and see what the true debt service coverage ratio is of what our true net income before debt is divided by the interest-only payment, and then we want to see that to be at least a 1.25 cover. So that is another way to look at your risk or your leverage.
So it's cash flow to debt service.
Right, not NOI.
What's the term on those loans when you get full IO?
You can go 5, 7, or 10. Right now, we favor the 5 because we don't feel like rates are so low where it's like, yeah, I love this rate. I want to love it for 10 years. We just think it's kind of like, I love this for 5 years. So.
And you'll correspond your IO period with
the loan term. Yeah, it makes the most sense to do 5-year loan, 4.5 years yield maintenance, 5-year IO. Oh, you're getting kicked out.
You said cash flow,
Which is everything below the line. So
everything below the line,
NOI is what we call above the line.
right,
Cash flow is below the line.
but you take below the line plus above the, everything.
All expenses.
All of it is below
And you're at
the line.
125. You want to be above that.
That's what we're shooting for. But what that does, it'll give you certainty with distributions and
Right.
things of that nature. So it enables us to go, man, we got a good cushion too in case something happens to
Yeah.
the property, while being able to stay consistent with our distributions.
Cool.
Because cash flow becomes a pretty big deal for investors as you get.
Big deal.
Yeah, that's why if you put in all these expenses and kind of load up the cash flow and assume, because if you pre-raise your CapEx, that's a one-time thing. You're gonna run out of that money, right? And so we want to look and see, okay, that money's gone. We can't just bank on reserves to fund CapEx. We need to spend it out of the revenue, and then we want to load that up so that the cash flow looks as conservative as possible. Because I'd much rather be aggressive on what hope I can sell the deal for on my exit cap rate, and then have the most real deal cash flow projection for investors. All right,
Thanks, guys.
cool.
Great job. We'll be in
I have a
here.
quick question about
Yeah.
that. I haven't cracked open the underwriting tool.
Mhm.
How do you incorporate, I'll just say macro market factors? Like you evaluate obviously the asset itself,
Yeah,
but then, I don't know, let's say the Austin market, not as strong as the Houston market.
right, exactly.
Multifamily, so
Right.
how does that factor into your current?
There's a few ways. There's a few ways that you would pull some levers. You do the annual rent growth,
Mhm.
right? So